Managing accounts receivables collections is challenging for most businesses that sell on credit, and negative surprises can quickly lead to frustrated sales teams, frustrated management, and to cash flow crunches. Still, many businesses rely on simple aging statements and the misunderstood day sales outstanding metric to measure, track, and prioritize their own efforts. In this webcast, we'll review issues and improvements to traditional DSO, and we'll introduce complementary metrics and techniques that businesses can use to better manage collections, lower risk, and boost cash flow. My name is Brian Sudoff, co-founder and CEO of Tally Street. For small businesses who want to grow and get paid, Tally Street provides customer insights generated from accounting data that businesses can use to anticipate problems before they happen. The inspiration for Tally Street comes from my own personal experience. Most of my career has been in big data analytics and software. But then about 5 years ago, I started a more traditional business, a liquor distributor, and very quickly ran into trouble managing and prioritizing the collections from the liquor stores and bars that I sold to. And I'm certainly not alone, and none of us are alone. Managing collections is a huge problem for most businesses. Small businesses collectively have about $2 trillion in accounts receivable in the United States. For each individual small business, that also averages about 40% of their assets. So it's a huge portion of a small business's balance sheet tied up in effectively loans that they've offered other businesses that could be used to pay their staff, pay their teams, and grow their own business. But even worse than having that large AR balance is writing it off. And collectively or overall, businesses write off 2% of AR every year. So on that $2 trillion, that's $40 billion that small businesses end up losing by not managing the collections process better and avoiding credit risk problems. If we look at the potential impact of just slow collections on a business, let's say a $3 million business improved their collections performance from 59% to 85%. How much more cash would they have at any given time? The answer ends up being about $66,000. That's a substantial amount of money for most people, and it's certainly a lot of money to a $3 million business who, again, could use that to better grow their small business. Fortunately, we have a number of KPIs to track performance, and let's go through them and evaluate them in a little more detail. So the first and most well-known collections metric is Day Sales Outstanding, or DSO. However, it's also the most misunderstood metric. What most people think it is the average number of days it takes to collect on invoices. But what it really is accounts receivable expressed as a multiple of average daily sales. In other words, this metric is great for financial analysis, for helping understand the efficiency of a balance sheet or the composition of a balance sheet, but it's not very good for operations, as we'll soon see. So there are a lot of ways that DSO can be misleading. Look at the formula below. The way to calculate DSO is divide, again, average accounts receivable by average daily sales. And let's say a business always collects in 30 days. What happens if sales grow very quickly at the same time that collections remain in 30 days? Well, the average sales per day number would increase as sales increase. That would increase the denominator in the simple formula, and the result would be a lower DSO. So if sales suddenly jumped up, the company would look like it's collecting on sales more quickly when really it's just been selling more quickly. The opposite is also true. What if sales slowed very quickly? Then average sales per day would be a smaller number. Average or accounts receivable and collections would stay constant, at least in the near term, at those 30 days, but the resulting DSO formula would look worse, would start to increase, making it look like the operations team was doing a worse job collecting when really it was only a short-term fluctuation in sales. Or what if AR balances were growing not because of changes in sales, not because of changes in collections, but because of changes in the composition of those sales. So if more sales were made on credit, then the accounts receivable amount would increase, which would make DSO larger when the business was still collecting on 30 days. So how would you like to have your bonus based on DSO? There's so many factors that can skew traditional DSO that are unrelated to how well a collections team is doing their job, that I don't think anybody would like to be measured, their performance be measured based on traditional DSO. So fortunately, there's a version of DSO called true DSO that is the dollar-weighted average of the actual number of days it takes to collect on an invoice, instead of a ratio between the balance sheet and the income statement. The good news is that this removes the skew or the changes caused by short-term fluctuations in accounts receivable or sales. The bad news is it's much harder to compute. Where the prior number could be computed off the income statement or the balance sheet, to compute true DSO, we have to look at every single invoice and the difference between when the invoice was issued, when payment was received, and then calculate a weighted average. Fortunately, we have computers that can do this now, so there's no longer any reason not to use true DSO for internal operations measurement. At Tally Street, we have a small variation on true DSO that we call Tally DSO, which is just an adjustment to handle partial payments. So the resulting formula is a little more granular, but it makes sure that a business gets credit for collecting some money along the way through the collections process. So now that we have an accurate measure of DSO, let's look at how we can actually put it to use, how we would compare it or evaluate a number within a business. So let's assume that two companies, Widgets Inc. and Legal LLC, both have a DSO of 45. How do you think they're doing? If we just know this information, DSO of 45, we would assume that and know that Widgets and Legal are both collecting payments in 45 days, so we would assume they have about the same performance. However, let's assume Widgets Inc. issues invoices with payment terms of net 60, and Legal LLC issues invoices with terms of net 30. Now, a DSO of 45 looks great for Widgets, who's collecting payments on average 15 days before the terms say that the payments are due. And it looks terrible for Legal LLC, who's collecting 15 days later. Or another example, let's assume that within Widgets, different customers are offered different payment terms. Now, is that 45 number good or bad? We don't actually know unless we go in and look at each individual or the mix of customers' payment terms during that same period and average them out and see if 45 would be good or not. The key takeaway is that DSO performance, the number, is really relative. It's relative to each individual business, and it's even relative to a time period being analyzed and the makeup of the invoices and the payment terms on the invoices during that time period. So DSO tells us on average how many days it takes to collect on a payment, but it's often very useful to know how many days it takes to collect on late payments. So average days delinquent is very similar to traditional DSO, but again, it's only for those late payments, and it tells us how late those late payments are. Unfortunately, traditional average days delinquent suffers from many of the same problems in DSO. In fact, you can see the left side of the formula below, accounts receivable divided by average day sales, is exactly the same as traditional DSO. We subtract from that the ratio of current AR to average day sales, which is our best possible DSO, and that's left with a DSO measurement for the numbers that are late. But again, it would be skewed in the exact same ways that DSO ends up being skewed. So similar to true DSO, we have another metric called real ADD. Real ADD gives us the weighted average number of days that late payments are late. Similar to true DSO, we do that by looking at every individual late payment, finding how many days it was late, and then doing a weighted average of those payments. Again, very difficult to do by hand, made better with a spreadsheet, made even better with software. So now that we have DSO and ADD, we have two different metrics for how well a business has received payments. But what about things that are not yet paid? So days beyond terms is a measure of overdue AR, really what we would see on our aging statement. DBT is the weighted average number of days that those overdue amounts are overdue or are late. Essentially, it is an average of the aging statement. So if the aging statement could be boiled down to a single number, that's days beyond term. By boiling the aging statement down to a single number, we have a metric that we can use and easily compare from period to period, from month to month, quarter to quarter, and year to year. Now that we have our three core metrics, DSO or days sales outstanding, ADD or average days delinquent, and DBT or days beyond term, we can look at how to use them together to better understand the performance of a collections team or a business's ability to collect on the invoices that they issued. So tracking only one of the metrics by themselves will only tell you part of the story, and it can actually be dangerous. For example, let's say maybe you and a client are keeping an eye on days sales outstanding, and it's staying the same or even getting better. You could be misled into thinking that you're doing well or at least staying steady. However, at the same time, if DBT was increasing, what it really says is that what you're collecting well, but you're not collecting on a number of other invoices. So the key is really understanding how these three interact together, and you can actually read charts of the three together similar to maybe reading tea leaves and learn a lot about how business is performing and what challenges they might face. So here's a chart of our three key metrics, DSO, ADD, and DBT, over 12 months, from March 2019 to March 2020. We generally see a lot of fluctuation, especially early on in the first few months, then a little bit of a steady state, and then change towards the end of March. But let's zero in on a few slices of this data and interpret what we see happen. So first, let's look at March to April of 2019. And what do we see and what do we think is happening in this case? The first thing we probably notice is that ADD, the blue line, spikes quickly, highly, from under 20 to over 60. That's a big jump in 1 month. If we only looked at that number, we would basically say that we were collecting a lot of really late payments. Could be a bad thing, but maybe not if it's a short-term spike. If we look at the green line, which is tally DSO, we see that it also increases, but not as much. This probably confirms the first guess that we collected a bunch of late payments, because tally DSO or DSO includes both on-time and late payments, while ADD only focuses on late payments. So while you'll see them move together, you'll usually see DSO move less dramatically or to a smaller degree than average days delinquent. To confirm our interpretation of this chart, we could look lastly at DBT, or days beyond term, and we see that it decreased at the same time that ADD and DBT increased. So this kind of comes together with a story that says that the business probably collected a bunch of late invoices. Maybe they were very large, maybe they were very late, maybe some combination of both. And that caused ADD to jump from, again, under 20 to over 60. That also pulled up DSO, and because we removed value from the aging statement by collecting the payments, we saw a decrease in DBT. So in this particular situation, an increase in DSO and an increase in ADD is actually a good thing because the business was collecting on longer overdue payments. If we go to the other end of the chart and look at the January 2020 to March period, we get a little bit of a different story. In this case, we see that ADD and DBT were trending down. If we only looked at those metrics, we might conclude that the business was actually doing a better job of collecting because they were bringing in payments on average more quickly than they had in the past. However, at the same time, we see DBT increased. So what that seems to suggest is, yes, maybe some payments came in earlier, but other payments were not being collected at all, and DBT was starting to grow. And if we remember not that far back to March 2020, that was the beginning of the COVID lockdowns when many businesses were starting to delay paying their bills in order to conserve cash, and we have an early signal of that happening. Now let's look at the middle slice of this chart, from July 2019 through January 20. We don't get as clear of a signal during this period. We see that ADD and DSO are relatively steady across the period, which suggests kind of ongoing standard for this business collection periods. However, we do see that DBT increases gradually but steadily during this period. Again, because DBT is an average of our aging statement, what that basically tells us is that our aging statement was gradually getting worse, or more invoices, more amount of money was getting later and later uncollected. We see that confirmed a bit in January 20, where both ADD and DSO increase while DBT decreases, which suggests that some of those outstanding invoices were finally collected. So similar to the previous April timeframe, we see a small jump in ADD and DSO, while our outstanding invoices, as measured by DBT, gets a little bit better. So analyzing all those three numbers is certainly doable. It's informative, but it's a little more work than we need to do. What we would really like to have is a single collections KPI that could tell us more broadly how well we're doing and when we need to dig into the details. So what would we want that metric to do? Well, we'd want one number that represents or captures both paid and unpaid amounts, unlike DSO, which is for payments, and DBT, which is for outstanding invoices. We'd also like that number to automatically handle different payment terms. So if we have a mix of customers getting net 15, net 30, net 45. It would be great if we're working with multiple clients to have a number that is easy to benchmark, a number that we could compare from client to client, which we found we cannot do for DSO since every business has different payment terms. And we'd like that number to, just at a quick check, tell us whether we're on track or if we need to dig into the details. Fortunately, there is such a number. It's just not well known, and it's the Collection Effectiveness Index, or CEI. So maybe one of the better but least well-known collections KPIs. It has the additional advantage of being very simple, easy to explain, and easy to benchmark for any business across different time periods, but also across multiple businesses or multiple clients. What CEI tells us is what percent of what we should have collected did we collect. Very easy for business managers and non-accountants to understand. If you have a score of 85%, it means you collected 85% of what you should have. 90% is better than 85%. You collected 90% of what you should have. It doesn't matter what the underlying payment terms are or how the business has changed. It's a great comprehensive measurement of overall collective effectiveness. So here's another view of that slice from July 2019 through January 20, where the signals weren't that clear looking at ADD, DBT, and DSO. Looking at CEI, it's much clearer. We see that collections effectiveness increased a little bit through October 2019, and then dropped dramatically through December, going from 70% to 48%. This is a much clearer signal than we saw in the previous slides. And then we see the small improvement to back in January. As we saw in the other slides, we assumed that some collections were being finally pulled in. So now that we have great metrics for measuring how well we're doing collecting on invoices, or how well a client is doing collecting on invoices, let's talk about ways that we can improve collections. So one great way to improve collections is to do a better job prioritizing those actual collections efforts. So instead of relying on a simple aging statement, which really lacks any context, it's just a list of invoices and whether they're 30, 60, 90 days late, we can prioritize collection efforts based on the client's underlying payment risk or their change in behavior. So the riskier customers would be pursued more aggressively than the less risky customers, even though their invoices might be older than the more risky customers. Another thing we could do to help scale our operations and make them more effective is automate. We could automate sending payment reminders to customers by sending them emails whenever they're reaching a threshold in terms of number of days late, and we could calibrate that based on how risky that customer appears to be. We could also create to-do lists or tasks for internal teams to follow up with customers at defined time periods or thresholds. And we could create credit policies that drive the right incentives for our customers. So in a perfect world, we could simply shorten our credit terms from, say, net 30 to net 45 to improve collections. But more commonly, we might have to provide an incentive for early payment. For example, 110 net 30, 1% off if someone pays within 10 days instead of waiting for the full 30 days. Or we can impose a penalty for late payments. Applying a penalty or expressing a penalty is a great way to at least set the expectations that customers should have. It helps support the collection efforts by being able to mention the penalties and present the penalties to customers. But then, of course, they can be waived when payment is finally made to help generate goodwill after the collections process. A great way to prioritize collections based on customer behavior is to first segment or group customers using their behaviors. This is also a great job for software, very difficult to do manually, but software can go in and look at how much a customer spends, how frequently they buy, and how well they pay or how well they don't pay, to group or segment customers into categories like champions, those who are your very best, or late payers, those who might be good customers if only they paid on time. Knowing this information, collections teams, customer support, even sales can better manage how they communicate with customers, how aggressively they pursue customers based on their historical performance. If we look at summaries of that performance by segment, we get a better appreciation of this. So our champions in this particular demo example, this business has 33 champions who have an average lifetime value or a total spend of $183,000 each, buying over 100 times and paying very well, paying in an average of 18 days. If we go all the way to the bottom of this table, second from the bottom to late payer, 23 customers, a pretty large category of customers in the late payment category, and their LTV is second only to the champions. But when we look at how well they pay, 81 days versus 18, more than 4 times worse in payment performance. Focusing on these late payers who also, as the numbers show, are large customers is a great way to quickly move the needle and boost performance at a business. If we go down to the individual customer detail, we can see in this demo company that Bailey Group is a late payer, taking an average of 77 days to pay on invoices. They're the third best customer as measured by lifetime value, but they take more than twice as long as the best customer, who takes 33 days, and far, far more than the second best customer, who seems to pay essentially COD. This type of information on an individual customer level is a goldmine for CFOs, CEOs, heads of sales, marketings, and yes, of course, collections. And one way it can be used in collections is to boost our prioritization. So now, instead of relying on just an aging statement, which misses or doesn't have the extra context that we need to understand behavior, we can take that average payment performance, compare it to current outstanding invoices, and prioritize much more smartly. So in this example, the invoices that immediately bubble to the top are not necessarily the oldest ones, but they're the ones where the customer is later than usual, later than they usually pay, a sign of potential credit risk or maybe financial troubles at that business. And they're larger invoices, so invoices that have a greater impact on the cash flow to us, to the company collecting on these sales. Most accountants think of a CRM as a sales tool, and it is, but it's also one of the best centers of customer information. And if we take these same accounting results, such as sales, but also overdue amounts and payment performance, and we put them into the CRM, then now you, your collections team, the whole organization have a very powerful tool for managing all customer communications far beyond sales. Even within sales, by giving this information to sales managers, you can help them avoid digging a deeper hole and selling more to customers who already owe you money. Additionally, if we think about what a CRM does, what a CRM does really well is manage tasks. A CRM is very good about sending emails, and at its core, what a CRM really does is track customer interactions. Now, if we add that same sales and payment information insights to the CRM, what we really end up with is AR automation. A system that we can use, the collections team can use, to see each individual customer, how strong or weak of a customer they've historically been over time, to put their communication in context, and also drive automation. So in this example to the right, which is based on a HubSpot example, but would be very similar in Salesforce or other CRMs, we could automatically send an email to customer not just when they're late, but we could calibrate that email based on whether they're unusually late, in addition to just being simply late. If you'd like to see collections KPIs and other metrics for your business or for the client that you have, you're welcome to visit TallyStreet.com and request a free report that's automatically generated based on the accounting data inside accounting platforms or systems such as QuickBooks, Xero, and Sage Intacct. The results will be sent to you in just minutes. Thank you for joining this webcast. I hope you found it informative and helpful.